I'll be presenting covered call one. My guide is Dr. Deepak Mani sir, and our co-guide is Dr. Sangeeta madam and Dr. Preeti madam. So CC1 or covered call one, wherein the primary position will be call, and here we sell the call at the level of ATM, and the secondary position will be the hedging position, wherein we buy uh, any asset which is equivalent to call. For if we are selling Nifty call, then we have to buy Nifty Bs, which will be the asset for the same. So when to enter CC1? So usually, whenever there is a bullish bias in the market, and whenever we see changes of reversal or any changes of or any gain of momentum, reversal we can track by horizontal markers or by oblique markers or oblique indicators, and by candlestick or chart patterns. If any of reversal or momentum is present and with bullish bias, we try to enter with CC1. Here our objective will be to capture the extrinsic value. By selling, we capture the extrinsic value, which will be at the max, which will be maximum near ATM. And here the loss will be whatever we gain in IV value will be our loss. So why do we buy asset? We buy asset so we minimize the loss what we will have if we sell a call by gaining in IV value. So by buying asset, we are just hedging the IV losses, which can be unlimited when we sell a call. So if it is a Nifty call we are selling, then our asset will be Nifty 50. So your asset will be Nifty Bs. So the lot size for Nifty, one lot is 50 value, and the contract value, suppose if it is based upon what is the anchor price or what is asset price into 50, it will be near about 8.5 to 9 lakhs as per the Nifty price. And so accordingly, we'll buy Nifty Bs of the same value, 8.5 to 9 lakhs. It will be around 4,500 to 5,000 round figure, whatever the contract value is. So round figure we consider 5,000. So in CC1, the criteria should be should be always a near ATM sell call. We are selling the call near ATM. Why? Because extrinsic value which we want to gain will be maximum at ATM. And whenever we move the asset from away from this ATM, any side, the EV value will fall. Then we are selling this call. So our profit will be sell minus buy. So we have to buy on a later date. So sell minus buy. And second criteria here should be extrinsic value percentage should be at least 2% for 1 month. And if you are considering a 15-day call, we are entering half a month call, then it should be at least 1%. We should enter the call wherein the strike price is having more number of zeros or a round value, round figure. So 18,000, 17,000 or 17,500, 18,500. That should be the strike value where we should focus more. But if there is crisis of liquidity, then we can enter where there is at least maximum number of zeros what we can get. Where EV value is more, liquidity is more. So near ATM call, where we'll get more value of EV, and strike price should be 1 to 2 places above or below the ATM range. Your delta value should be 0.4 to 0.6. So about margin and risk, for margin of one lot, we get around span value. If we consider, it should be in the range of 1 lakh, depending upon the Nifty price. Span here, one example is given for a strike price of 17,000 for Nifty 27th April 23. So here span margin is around 83,000, exposure margin around 17,000, and total margin around 1 lakh. And we are receiving, as we are selling this call, we are receiving premium based upon our call last traded price. Okay, so we are receiving the premium of around 16,000. So management of risk, we as we are selling one call, we can take for this one lot we need around 8.5 to uh, contract value of around 8.5 to 9 lakh, and margin around we need around 1 lakh. So 50% will come from equity basket. Whatever asset we are buying here, in this case, Nifty B, the Nifty B will provide us margin of 50%, and then rest of the margin will come from either liquid Bs, liquid funds, or we can provide it through cash. So risk management, we are in the leverage, we are providing equal to the contract value, the same amount of whatever the contract value is, we are buying same amount of asset. So leverage is around 1, and so minimum risk we are taking here. So it is a peaceful strategy. So what are the exit plans? If the market is sideways, so if the market is going up, down, around 5% up and down, and it is sideways, so we'll try to roll over. So if it is, if we want to roll over, we'll see the extrinsic value percentage of next month of same strike price. If it is greater than 0.5%, we sell this call and we buy this call, and then we sell the next strike price next month same strike price call again, and the asset will remain untouched. This will continue till asset remains sideways, and similar criteria are fulfilled. That is, EV percentage is greater than 0.5. Then, if asset moves up, then we have to consider whether the EV percentage of next month call of same strike price is less than if it is greater than 0.5. If it is less than 0.5, then, and if the call is ATM, then we consider exiting the call as well as exiting the asset. So why do we are exiting at the call? Because it is in ITM. So we are taking few IV losses. So as IV losses, if it goes, if the asset goes significantly up, IV losses keep on increasing, and whatever IV losses are there, here EV extrinsic value gain what we have done will reduce the IV losses. So overall profit will be overall loss will be little bit less comparative to overall loss through the IV loss. So by selling the call, we are selling at a loss, but comparatively at less loss because of EV profit. And at the same time, we are selling the asset, so, because the asset has gone up. So here we are making profit, and here we are hedging both. So even though we are making a loss in call, in asset we are making profit. So one position will always make profit in CC1. In plan C, if asset falls down, then same, we are going to see next month EV percentage. If it is less than 0.5%, and if it call is OTM, that means the asset has gone way beyond the strike price, then we have to square off the call. We buy the call. Here we are going to make profit in EV, as IV will be 0 as the call is OTM, and asset will be untouched. We can again sell call at the same price when the asset rises up to previous anchor price, and we can repeat this plan till we exit at plan B. So our take home message will be CC1, sell near ATM and buy asset that is equal to the contract value what we are selling the call. The aim will be here capturing of EV. The positive side will be CC1, where leverage is 1, so the least possible risk. In CC1, one plan has always profit, one will have loss. So we are covering both sides, and it is more useful in sideways market and bullish market. Cons, major con will be capital, specifically large capital, and there is limited potential of profit here. If you compare to share Khan, if you are buying asset, it is limited number of profit, but potentially advantages you minimize the risk. So that is all. Thank you.